a lot of people, when they want to sell a security, let's say they bought a stock, they're up by, hundreds of percents, and they don't want to look at the stock, but they want to sell it when it reaches a certain price. For example, if the stock crashes, which is what happens when many stocks shoot up like crazy, and then come back down to earth. And this is what I recently did with one of my stocks that I'm up over 200% on. I set a stop limit, which I'm going to go over what that is, so that it sells a stock at a specific price if it keeps going down, but it also allows me to not sell the stock if the stock keeps going up, I don't have to check it every 10 minutes to sell at a specific time point if a stock suddenly crashes. Okay, so we're going to go over what it means to sell at market, sell at limit, sell at a stop market, stop limit, trailing stop market, and trailing stop limit. So this is just an example on my TFSA. This is through TD Webroker. And right now I own Slack Technologies. And let's say we wanted to sell at market. And what that means is going to sell at market price. Okay, so right now Slack is $43.29. Of course, like TD Webroker doesn't execute transactions on the weekends, but once Monday on market open, if you specify the price type at market, it would sell at market, so around $43.29. Okay, a price type limit would mean you would have to specify a price at which you would sell the security. So let's say you are only willing to sell the security if Slack goes up to $45. So you would just type 45, depending on what kind of interface you use and what brokerage you use. And this will mean that it'll only sell the stock, it'll only sell Slack if it reaches $45. Right now it's $43 and change. Okay. A stop market is basically the opposite of that. Okay, so let's say you want to take advantage of continued gains from the increase in stock price of Slack, but if it goes below a certain point, you want to sell it. Okay, and again, one advantage of that is if the stock decreases drastically, then you can sell it at a price that you're comfortable with, that you'll still make a pretty nice profit, but you don't want to wait around and wait for the bottom of the stock. So let's say you have, let's say Slack shot up by like 100% over the past 5 days. You're already making a really nice gain, and you want to sell Slack only if it goes to $40. So you just do a $40 trigger price, and you would specify the expiry date of this transaction. And if Slack were to drop below $40, it would sell all your shares of Slack or however many quantity you want to choose. Okay. So again, the advantage of this is you take advantage of, it only sells if the stock drops below a certain price. So you take advantage of the potential upside. So that's a stop market. A stop limit is, well, one, you have the trigger price and the limit price. The trigger price is the price at which the order will be active. So let's say you only want them, like your interface, your brokerage, to consider selling your stock. Let's say if it reaches like $42.50. Okay, so it drops down by less than a dollar at $42.50. That's when your transaction will become active in the market. Okay, and let's say you're not willing to sell any more shares if they drop below $42. So what you would do here is you put $42, and basically that means this is pretty much in the simplest terms, this gives you a range at which you will sell your Slack shares. Okay, so what this means is your brokerage will only sell shares in between $42 and $42.50. And that's exactly what I used to sell my CCIV shares. As we can see here, this order was executed where it was a stop limit where I put the limit at $56.55, and that was what's it called? Excuse me. That was the trigger price, and then the limit price was like $56.50. So it sold in between $56.55 and $56.50. So I would still be able to return over 200% return on my stock. Okay, and that was useful because if we go on the 1 day chart, the stock dropped like crazy here, and I put a trigger price at $56.50, and therefore it sold all my shares in between that range when it was down to $56.50. Okay, so I'm very happy that I did that because I didn't have to look at the stock, and it just executes the order automatically for you. Okay, and the next two are also kind of useful, but they're a bit harder to wrap your head around, but it's basically the same thing. So What this is the trigger delta for a trailing stop market is the amount of dollars you will be able to withstand slack or whatever the stock you're trading at is going down before it sells it. So let's say we do $3 here. That means it will sell slack if it reaches or goes below $40.29. Okay, because that's a $3 off of $43.29 that it's trading at now. Okay, you can also do a percentage, right, where it will only sell if it goes down by 3 percentage points or 10 percentage points. Okay, so let's say 10%, so it'll only sell if it drops below $38.96. Okay, the cool thing is that if the stock goes up to $45, it'll recalculate the percentage and it'll sell when it's 10% below $45, which would be $4.50 below that. So it'll sell when it's like $40.50. Okay, so it readjusts when the stock moves higher, but it does not readjust when the stock moves lower. Okay, because then you'll never sell. Okay, you can imagine if it readjusts when this reaches $40, then you'd be like $3 lower than that would be 37, and if it goes down to 37, then the readjustment would be like $34, and so all the way down. So it readjusts on the way up, but not on the way down. And finally, a trailing stop limit is the same thing, but you have a trigger delta where, let's say you're comfortable with the stock falling to $3 maximum. So you would say like, okay, execute the order if, let's say, it's like $2.9 below its current price, but limit it so that it only sells my shares within the range of $2.9 down and $3 down. Okay. And so you have this range between $37.40 and $40.39 where it would execute your order. Okay, so that's all I have for you. Again, I took advantage of this, and I think a lot of people don't understand what these mean, and a lot of people just sell at market price. But I think you can take advantage of certain volatile stocks that move rapidly up and rapidly down, and that you don't need to always watch it if it goes up or down. Okay, so that's all I have for you. Let me know if you have any questions down below. One thing I will say though is that WebBroker, it charges a $9 fee every time you complete a transaction. Excuse me, if you look here. So here, Churchill Capital, I sold all my shares at $56.51, whereas my price was $18.17, whereas the commission was $10. I also use Wealthsimple, and there's a referral link down below, and I'll be very straight with you. You get $10 if you invest $100 with Wealthsimple, which is a $0 commission trading app, and I will gain also $25 for every referral link that you click on. Okay, and that's only if you're from Canada. But anyways, I made over $1,000 US on this stock. So of course I bought it at $500 and I sold it, and my net amount was $1,515. And if you take the difference between those two, I made a nice, $1,015 return on this investment of Churchill Capital. Okay, so I think that's really cool. And of course, if you have any questions, please let me know down in the description below. You can. There's also a couple links to track my buy and sell orders. And I hope this video was some use for you and teaches you how to take advantage of all the options of your interface that you can take care of when you're trying to sell a stock. Anyways, take care. Bye. See you later. Love you all. Have a great weekend.